This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on wedges. I'm going to begin by talking about what a wedge exactly is. When I use the term wedge, I'm talking about a pattern that has 3 or more reversals. In one direction, so a total of 5 reversals, 3 one direction, 2 in the other direction, and it's tilted either up or down. It usually is contracting, so it's basically a contracting triangle that's sloped up or down. Sometimes there's a 4th or a 5th leg in the wedge as well. When I draw lines, I'm trying to highlight what the market is doing. It makes it easier to think about how to place a trade. And sometimes lines are not perfect. Most of the time, lines are not perfect. A line requires 2 points, and you want to see what happens with the 3rd point. I keep changing the lines as new points are created. And the result is that sometimes prior points will go beyond the line or not quite reach the line. And that leaves me with different choices as to which points to use to draw the line. In general, if I'm choosing between 2 lines, one has an overshoot and the other has an undershoot, I prefer the line with the overshoot. This is a continuation of the list of reversal patterns that I've been discussing. And like all of the other reversal patterns, even wedges involve some type of trading range. For example, a final flag, or after the wedge reverses, is often a major trend reversal, which is usually part of a trading range. I always think of wedges as either a flag in a trend or as part of a reversal. For example, we have a pretty strong breakout here, and we have a bull bar, and then a second bull bar that led to a small reversal, and then a third bull bar. This is a wedge bear flag. It does not matter that the beginning of the bear flag began before the bear trend ended. That's common for the market in transition from a trend into a trading range or a trend into an opposite trend for the transition to begin before the trend ends. The wedge bear flag is a pullback, and that means chances are the bear trend will resume. The bear flag is a small trading range or a small bull trend. A breakout above a wedge bear flag is a reversal into a small bull trend. A wedge top is a reversal of a bull trend. We have a bull trend, and we have 1 push, 2 pushes, 3 pushes up. The trend line and the trend channel line are converging. It's a convergent channel. We have a bull breakout above the channel, and now we are reversing down. So a wedge top is a wedge reversal. A wedge bear flag is a pullback. Every bull channel is almost always a bear flag on a higher time frame chart. And a bull channel, 75% chance you'll get a bear breakout either by going down or by going sideways. And then the market evolves into a trading range. And therefore, a bull channel is ultimately a bull leg in what will become a trading range. Time frame chart. and a bull channel, 75% chance you'll get a bear breakout, either by going down or by going sideways, and then the market evolves into a trading range. And therefore, a bull channel is ultimately a bull leg in what will become a trading range. A wedge is simply a triangle where the triangle is sloped upward. Or sloped downward. There are often different ways to draw wedges, and wedges are often nested, smaller ones inside of larger ones. We have a bull breakout, a pullback, second bull breakout, pullback, and then a third rally and a reversal down. Some computers see the wedge as 1, 2, 3. Other traders see it as a larger wedge, 1, and then 2, and maybe 3. It doesn't matter as long as you understand what's going on. The market keeps trying to break to the upside and failing. You could say we have a strong bull trend here, and then a bear breakout. I did not draw the trend line. And traders will look for a resumption of the bull trend to fail. In this particular case, this is a wedge, higher high, major here, and then a bear breakout. I did not draw the trend line. And traders will look for a resumption of the bull trend to fail. In this particular case, this is a wedge, higher high, major trend reversal. This, on the other hand, is a pullback in a bull trend. It's a wedge bull flag. You expect the market to resume up here. You expect the market to reverse down. This is a small bear trend within a larger bull trend. A triangle that slopes upward, 1, 2, 3, 3 pushes up in a trading range. It's a triangle. It's sloped upward, so I use the term wedge. Convergent lines, you can call it a bull channel, or you can call it a wedge. A rising wedge is a potential top. A bull channel, a wedge bull channel, is usually a bear flag. The odds are you get a bear breakout. There's overlap here. The breakout above this high, pull back below the high. The breakout above this high, pull back. The breakout above this high, pull back. When you have a wedge channel where there's overlap, there's higher probability that you'll get the bear breakout. We're trying to get a bull breakout above the top of a bull channel. 75% chance that fails within about 5 bars, and you get a test of the bottom of the channel. That's not saying much when the bottom of the channel is so close, but given the entire picture, the bears might be able to get a test to the bottom of the channel, or even possibly a bear trend. Here we have a reversal bar, a close below the midpoint. It's only a doji, but it is a reversal bar, and it's a reasonable sell. Traders will sell with a stop just below the low of that bar and get filled here. Pretty good looking entry bar for the bears and very good looking follow through. This bar is even bigger than that bar, and it's closing on its low. It looks like the market's going lower. A series of consecutive bear bars closing on their lows. Strong breakout, probably at least some kind of a measured move down. The goal is, after a wedge top, a swing down. 10 bars, 2 legs as a minimum reasonable goal. This could be the first leg, and then a small pullback, second leg, or this entire move down might be the first leg. And then the market might get a larger pullback and a larger second leg. Remember earlier I said there were different ways to draw this wedge. Some computers would say the top of this breakout is the first push, and maybe this is the second, or they might say first, second, third, and fourth push. They may say the wedge channel has 4 pushes up. Nested wedge, I view this as a large first push up, a pullback, second push here, and then pullback, and then the third push subdivides. So it's a nested wedge, a smaller wedge within a larger wedge that has a higher probability of leading to a reversal. A wedge top is a climax, and like all climaxes, it usually leads to at least a pullback, or at least a pause in the buying. Climaxes can last a long time. A series of bull bars here, 5 bull bars, climactic move here, a series of strong bull bars here. The rallies within a wedge top are often strong enough often to be a buy the close rally. Traders will buy closes, confident that the market will go at least a little higher. The same with here. It's a buy the close rally. And here as well, even though the bars are small through here, these are buy the close rallies. At this point, look at the pullbacks. Only 2 bars down here. 1 bar here, 1 bar here, 2 bars here. We have a part of the large wedge that is also a small pullback bull trend, which you can call a short squeeze. The shorts are getting squeezed. The bears who keep selling reversals are being forced to buy back the shorts by bulls buying below the lows of the bars, more buying than selling. A small pullback bull trend is also climactic and unsustainable, and therefore it's appropriate that it's occurring within a wedge, which is usually made up of a series of climaxes. Small pullback bull trend is a FOMO trend, fear of missing out. The bulls are buying because of momentum rather than because of fundamentals. They're not buying up here because it's cheap. They're buying up here because the market's going up and they think it'll continue up because the pullbacks are small. FOMO trades, fear of missing out trades, are crowded trades. Everyone's long, and once traders start to take profits, everyone exits in panic. It just takes a couple bars here to make all of the traders who bought during the last 10 bars now holding losing positions, and they're going to be very quick to get out. That happens all the time with crowded trades. When too many traders are long, they're going to be quick to get out. They know they're buying based on momentum, and as soon as the momentum ends, everybody is going to be quick to exit. We have a bear breakout, first push down, second push down, third push down. You can call this a first push, you can call this, you can say this is a wedge, 1, 2, 3, and the bottom did not lead to much of a reversal. You can call this a wedge. Bear trends are always forming wedge bottoms. Both trends are always forming wedge tops. This is a wedge because it's a bear channel, wedge bottom. It's a bear channel, and the lines are converging. We're getting overlap. If you're looking for a wedge bottom, you want overlap. You want the pullback from the second leg to go above the low of the first leg. That increases the chances that because it's a bear channel, wedge bottom, it's a bear channel, and the lines are converging. We're getting overlap. If you're looking for a wedge bottom, you want overlap. You want the pullback from the second leg to go above the low of the first. Leg. That increases the chances that if you start to get a reversal, it'll be a successful reversal. Overlap. You want the pullback from the second. We're getting overlap. If you're looking for a wedge bottom, you want overlap. You want the pullback from the second leg to go above the low of the first leg. That increases the chances that if you start to get a reversal, it'll be a successful reversal. You can draw a channel line. We have a reversal up, reversal up. You can draw a line. And here we're breaking below the line, and we're reversing up. Failed breakout below the bottom of the bear channel. That's good for the bulls. Strong reversal bar. A little bit of a micro double bottom. This bar went down and up, and then we went down here and then up here. Good for the bulls. Bulls will buy above the high of that bull bar or the high of this pullback bar. The goal of the reversal is 10 bars, 2 legs. Approximately. It could be a lot more, usually not much less. So first leg up, pullback, second leg, or a complex first leg up, pullback, second leg. Another goal in a wedge reversal is a test of the top of the channel, either here or here, and ultimately we reach both. Whenever you have a sell climax like this and then a reversal, one reasonable target is to get just a little bit above that high, which we got over here. To get just a little bit above that high, which we got over here. The goal of every market is to find a price that will attract the most trading. A fair price, a price that the bulls find good for buying, the bears find good for selling. And to find that fair price, it's constantly changing. There's constant information coming into the market. Every fair price is constantly changing. The market usually has to go too far one way to find out how far enough is. And that's what happens with a wedge bottom. The market's probing for a bottom, and then at some point decides it has gone too far away to find out how far and they're changing. There's constant a fair price, a price that the bulls find The goal of every market is to find a price that will attract the most trading. Fair price, a price that the bulls find good for buying, the bears find good for selling. And to find that fair price, it's constantly changing. There's constant information coming into the market. Every fair price is constantly changing. market usually has to go too far one way to find out how far enough is. And that's what happens with a wedge bottom. The market's probing for a bottom, and then at some point decides it has gone too far, and the fair price is probably higher. So it reverses up and starts probing in the opposite direction. You see 3 pushes down, and the legs down are getting smaller. Plus you see overlap. The pullback from the second leg goes above the low of the first leg. There's less interest in lower prices. The market sees the buying pressure. They see that the bulls who buy at this low can make money. They assume the bulls who buy at this low will make money. Less interest in buying lower. The reversal attempts are coming after fewer bars. The bears are deciding that this fewer bars. The bears are deciding that this price is too low to sell. They only want to sell higher. And the bulls believe that the market fell too low and that it's a good value, and they start buying. They start buying below bars. And then they're starting to buy with stops on reversals up, confident that we've gone too far down. Both bulls and bears buy. The result is a reversal. Usually, when you get a reversal, you get a couple legs up because you get trapped bulls and bears. You have bulls who did not buy initially. They're trapped out. They're hoping for any kind of a pullback to buy. That results in a second leg up. And you have bears who did not get up. On the reversal up, and then they see this and they decide, okay, it's going higher, and they look for any reversal down so they can buy back their shorts with a smaller loss. The result is you have bears trapped into shorts, and they're looking to get out, and they buy. You have bulls trapped out of a long. They're hoping for any kind of a pullback, and they buy. The result is a second leg up. they're hoping for any kind of a pullback, and they buy. The result is a second leg up. We're selling off here. Not all that strong. Big bear bar, small bear bar, pair of bear bars, bull bar, bear bar, doji. This looks like a bear leg in what will become a trading range. You have to think that we have a little bit of overlap here, so negative gap here. It's also a small pullback bear trend, and that has an element of long liquidation. Bulls. We have a little bit of overlap here, so negative gap here. It's also a small pullback bear trend, and that has an element of long liquidation. Bulls keep buying, and they decide they bought too soon, they have to sell, they have to liquidate, and that's happening repeatedly here. A tight channel, a small pullback bear trend that is climactic. Here it has a series of small sell climaxes. A wedge bottom usually has different types of sell climaxes within it. Here we have a 5-bar sell to close type of sell climax. These bear trends can last a long time, and they can create a pain trade. We'll see what they believe is a weak, broad bear trend, and they keep buying. However, they keep buying and they keep losing, and they start to feel a lot of pain. A pain trade is a low probability event, and that just goes on a long, long time. You look at it and say, wait a minute, how can this suddenly be getting so much stronger when we had bad follow through all through here? The bulls see this reversal up, they start assuming we'll get a major trend reversal, yet the market keeps going down. So the bulls who are buying are experiencing a lot of pain, and pain trades usually have at least 2 legs, one pullback, 2. Sell to close as a FOMO trade, fear of missing out. The bears sell not because the market is expensive, they sell because it's going down, and they believe it'll go down at least for a small second leg. And the result is they're not selling because of fundamentals, they're not selling because the market's expensive, they're selling based on momentum, and as soon as the momentum stops, everyone is trapped into shorts and they suddenly give up. It's a crowded trade, too many traders short, and once the momentum down ends, the bears buy back in a panic. Crowded trades often lead to sharp reversals. The bears give up, and when you get these sell climaxes, the trades are usually crowded, too many traders short. Remember, a wedge is simply a triangle that is sloped up. Here we have a 5-bar sell to close type of sell climax. These bear trends can last a long time, and they can create a pain. Trade. We'll see what they believe is a weak, broad bear trend, and they keep buying. However, they keep buying and they keep losing, and they start to feel a lot of pain. A pain trade is a low probability event, and that just goes on a long, long time. You look at it. These bear trends can last a long time, and they can create a pain trade. We'll see what they believe is a weak, broad bear trend, and they keep buying. However, they keep buying and they keep losing, and they start to feel a lot of pain. A pain trade is a low probability event, and that just goes on a long, long time. You look at it and say, wait a minute, how can this suddenly be getting so much stronger when we had bad follow through all through here? The bulls see this reversal up, they start assuming we'll get a major trend reversal, yet the market keeps going down. So the bulls who are buying are experiencing a lot of pain, and pain trades usually have at least 2 legs, one pullback, 2. Sell to close as a FOMO trade, fear of missing out. The bears sell not because the market is expensive, they sell because it's going down, and they believe it'll go down at least for a small second leg. And the result is they're not selling because of fundamentals, they're not selling because the market's expensive, they're selling based on momentum, and as soon as the momentum stops, everyone is trapped into shorts and they suddenly give up. It's a crowded trade, too many traders short, and once the momentum down ends, the bears buy back in a panic. Crowded trades often lead to sharp reversals. The bears give up, and when you get these sell climaxes, the trades are usually crowded, too many traders short. Sell climaxes, the trades are usually crowded, too many traders short. Remember, a wedge is simply a triangle that is sloped up or down, and a triangle has 3 pushes up or down. As soon as I see 3 pushes, here up, 1, pullback 2, pullback 3, I think this might be a wedge top, and higher probability 3 pushes, the bears give up, and when you get these sell climaxes, the trades are usually crowded, too many traders short. Remember, a wedge is simply a triangle that is sloped up or down, and a triangle and pain trades usually have at least two legs, one pullback, two. Sell the close as a FOMO trade, fear of missing out. The bears sell, not because the market is expensive. They sell because it's going down, and they believe it'll go down at least for a small second leg. And the result is they're not selling because of fundamentals. They're not selling because the market's expensive. They're selling based on momentum, and as soon as the momentum stops, everyone is trapped into shorts and they suddenly give up. It's a crowded trade, too many traders short, and once the momentum down ends, the bears buy back. Panic. Crowded trades often lead to sharp reversals. The bears give up. And when you get these sell climaxes, the trades are usually crowded, too many traders short. Remember, a wedge is simply a triangle that is sloped up or down, and a triangle has 3 pushes up or down. As soon as I see 3 pushes, here up, 1, pull back 2, pull back 3, I think this might be a wedge top, and higher probability of a reversal if the lines are converging. Remember, a wedge is simply a triangle that is sloped up or down, and a triangle has 3 pushes up or down. As soon as I see 3 pushes, here up, 1, pull back 2, pull back 3, I think this might be a wedge top, and higher probability of a reversal if the lines are converging as they are. Here. There are always multiple ways to draw patterns. I'm picking this. Some computers will say this is the first push, second push, third push. Here we have 3 pushes, up, 1, 2, 3. It's a triangle. And since it's mostly horizontal, traders would refer to this as a triangle rather than a wedge. There's also a bear trend, bull breakout, higher low, major trend reversal, and a double bottom, higher low, major trend reversal. Traders buy for the reversal up. You can also call it head and shoulders bottom, left shoulder, head, and then right shoulder, and the right shoulder formed a double bottom. If you have a channel, you have a pair of lines. If they're sloped up, it's a wedge, and it can be a bear flag and a bear trend, or it can be a top and a bull trend. Here we have a wedge bottom. Does not look like a wedge, but it is. We have 3 pushes down. 1, pull back 2, pull back 3. A small double bottom created the first 2 pushes, and then the third push here. Again, different computers use different reversals to create the lines. Some computers will say the wedge began here. Others will use the pink lines and say the wedge began here. Some will say we got a wedge top here, 1, 2, 3. It tried to reverse down and failed. And then we broke to the upside, and the breakout above the wedge is failing. Another way to draw this wedge bottom, 1, 2, 3. Whenever you have a wedge, you assume there's going to be a 75% chance that you'll get a breakout. In the opposite direction. A wedge bear flag, you expect a reversal down. A wedge top, you expect a reversal down. Wedge bottom, a downward sloping wedge, you assume you get an upside breakout. A rising wedge, 75% chance you'll get a break below the bottom of the wedge, either by going sideways or by going down. A rising wedge, 75% chance you'll get a break below the bottom of the wedge, either by going sideways or by going down. Whenever I see a bull trend, whether or not it's a wedge, if it's in a channel like this, I think of it as a bear flag because I know the odds are there'll be a bear breakout either into a bear trend or into a trading range. A falling wedge, a bear channel, 75% chance there's going to be a bull breakout. A triangle, 50% chance you'll get a downside breakout, 50% chance you'll get an upside breakout, 50% chance the first breakout will reverse. We have a triangle, we have a bear breakout, and it reversed. Is this a wedge top or a triangle? This high is slightly above that. This high is slightly above that. We have 3 pushes up. However, the pattern is mostly triangle. What do you call it, a wedge or a triangle? Doesn't matter. The forces are the same. 3 pushes up. In a channel conversion, 75% chance in general. If it's a wedge, 75% chance you get a successful bear breakout. The flatter it is, the more it's a triangle. 50% chance you get the downside breakout. 50% chance you get the upside breakout. The bull's trying to get an upside breakout, and we see a decent sell signal bar. It's a reasonable short right below the low of that bear bar, betting on a failed breakout above a triangle or a failed breakout above a wedge. We're breaking below the bottom of the pattern. Is this a failed breakout? Trying to reverse up, trying to reverse up? Well, it is. However, it's also 5 consecutive bear bars. Chances are there are sellers above, and we'll get at least one small leg down. The bears therefore see this as the start of that second leg down, and they see this as a bear flag. They see the whole thing as a bear flag. We have a bear bar. That follows through after the bull breakout. Traders will sell just below the low of that bar, and they'll get filled on this bar. Is this really a failed breakout below the bottom of the wedge? Well, I think it's more of a pullback than a failed breakout. We did not get above the top of the triangle or the top of the wedge. This is more likely a pullback from this 5 consecutive bear bar breakout. Above the top of the triangle or the top of the wedge. This is more likely a pullback from this 5 consecutive bear bar breakout. Wedges are very common and they're present on all charts, but they're rarely perfect. In fact, most of them don't look like wedges at all. Here we have a wedge bull flag. We can draw a line down here. We can draw a line here. You can say, well, wait a minute, now there are only 2 pushes, 1, 2. But yes, however, there's a double bottom. We tried to go up here. We tried to go up again. We have 2 reversals up, 1 and then 2. That means 2 pushes down, 1, and then this little bear bar 2, and this is a 3rd push down. When you have a double bottom and a breakout below it, that is a type of a wedge. Bear bar, bull bar, bear bar, bull bar, and 3rd push down here, a wedge bull flag, a wedge pullback after a strong bull breakout. If you want, you can call it a triangle and say the first push down was here, which means this strong bull bar, in fact, was part of the pullback from this initial breakout. As strong as this is, some computers see this bull bar as part of the triangle, the pullback from this initial breakout. 3 pushes down, bear breakout, first push, and then a second push, and a 3rd push. Not really converging lines, but still, I think of it as a wedge bottom, and I look for a bull breakout. Wedge top, you can say, well, what are you talking about wedge top? You got 1 push, maybe first push here, and then are you calling this a second push and this a 3rd push? Yes, this is a breakout, and therefore it's a push, and then we have a second push here and a tail, 3rd push here. This is a small wedge nested within a larger wedge. This is the first push. Other computers will say that's the first push. In any case, it's a bull channel with slightly convergent lines. I think of it as a small wedge top. And on a smaller time frame chart, it might be a very good looking wedge top. We broke below the bullish channel, might get a second leg down, and we rallied up with 3 or 4 pushes, 1, 2, 3, and 4. This is a wedge bear flag, and we got a small second leg down. Leg 1, pull back, leg 2. Very tight bull channel, not convergent lines, but a series of buy climaxes, 1, and then 2, and then pull back, and 3. On a smaller time frame chart, this is probably a wedge. You could say this is the first push, second push, third push, doesn't matter. You have 2 or 3 pushes in a fairly tight channel. I normally would not call that a wedge. However, you can think of it as a wedge, at least an inferred wedge on a smaller time frame chart. You expect a bear breakout. You don't necessarily expect a big bear swing like that, but sometimes you get it. Maybe this is the first push, second push, maybe first push, second push here, and then third push there. Different computers look at it differently. I want to make an important point about drawing lines. The more legs that a pattern has, the more choices you have for lines. Every point is a possible location where you can anchor a line. Lines differently. I want to make an important point about drawing lines. The more legs that a pattern has, the more choices you have for lines. Every point is a possible location where you can anchor a line. The result of multiple reversals is that you often have several choices for lines. Some lines will have undershoots, where one or more points do not quite reach the line. Other lines will have overshoots, where one or more points go beyond the line. In general, when choosing between lines with undershoots and lines with overshoots, choose the lines with the overshoots because they typically highlight what the market is doing better. Here the market's on a bear trend, and you can see many pushes down. It goes down and reverses up, down and up. It does that repeatedly. Anytime you see 3 reversals, you have to be thinking about a possible wedge. We have a reversal up here, another one here, and another one here. Therefore, these 3 reversals create a wedge, point 1, point 2, and point 3. Once there are 2 points, I can draw a line. So point 1 and point 2 allows me to draw a line, and then I see that point 3 does not quite reach the line. It's an undershoot. In this particular case, I have a reversal up, and then I have a second reversal up. I can draw a line, point 1 and point 2. Once I see point 3, I can draw a different line. If I choose point 1 and point 3 for the line, point 2 is an undershoot. As I have these 2 wedges drawn, here point 3 is the undershoot, and here point 2 is the undershoot. The goal is to understand what the market is doing. Sometimes you have multiple choices for lines. You want to choose the one that highlights what the market is doing better because it helps you think about what to do next. Anytime the market tries to do something 3 times, it tries to sell off, but reverses up. Sell off, reverses up. Sell off is trying to reverse up a 3rd time. Typically, if the market tries to do something 2 or 3 or 4 times and fails, it then tries to do the opposite. The result is you often get a reversal after 3 pushes down. Typically, if the market tries to do something 2 or 3 or 4 times and fails, it then tries to do the opposite. The result is you often get a reversal after 3 pushes down. And the same is true here. We're getting a flatter channel, but it's also a wedge. I don't have a line drawn across the top, but you can see it's contracting. We're trying to reverse up, reverse up again a 2nd time, and we're trying to reverse up a 3rd time. The bear breakouts are failing. The bears are constantly trying to get the market to go down, and they're failing. At some point, they give up, and the market starts to try to do the opposite. It tries to rally. I said that there are 2 ways to draw lines here when you have 3 points. I could use point 1 and point 2, or I could use point 1 and point 3. The same is true here. I have 3 points. I need 2 points for a line. That means I have 2 ways to draw the line. I could use point 1 and point 3, or I could use point 1 and point 2. The lines I have drawn here have undershoots. Point 3 did not reach this line. Point 2 did not reach that line. Now, what happens if I choose the other points? For example, point 1 and 3, or here, point 1 and point 2. Those lines create overshoots. If I'm using point 1 and point 3 here, point 2 goes beyond the line, and therefore point 2 is an overshoot. Here, if I use point 1 and point 2 to draw the line, point 3 goes below that line, and point 3 is an overshoot. Here I have 2 choices for a line. The blue line is an undershoot. The gold line is an overshoot. I'm going to choose the gold line because lines with overshoots typically highlight better what the market is doing than lines with undershoots. It's easier to see what the market is doing. Here, point 2 is the undershoot, not point 3, but I typically choose the gold line because it has an overshoot, and lines with overshoots make it easier to see what the market is doing. I talked about what I think a wedge is. A wedge is any pattern with 3 pushes that is tilted up or down. It usually has a contracting pattern. The lines are usually contracting. It's basically a triangle that's sloped slightly up or down. Sometimes it can be sloped very sharply up or down. When you're drawing lines, you need 2 points to draw a line. A wedge has 3 points. That means you have 2 choices for the line. You could use the 1st and 2nd point, or you could use the 1st and 3rd point. Usually there's going to be an overshoot and an undershoot. One line will have an overshoot, the other will have an undershoot. I prefer to choose the line where there's an overshoot because that line typically highlights what the market is doing. I'm Al Brooks. Thank you for watching. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on wedges. I'm going to begin by making the point that wedges are rarely perfect. I'll then move on to talk about how most channels are wedges, whether or not the channels are conversion. And finally, I'll discuss the many different types of wedges. Sometimes a wedge has a leg that's only a single bar. And sometimes it's simply a doji bar. This leg 2 bars down, this leg a couple bars down. Here, the third leg, maybe it's this bear bar, maybe it's these 2 bear bars with that low. 1 bar down, 2 small dojis down. Here we have 4 legs, 1, 2, 3. Some computers will say this is 1, 2, 3. These are small patterns, and they're probably clear on smaller time frame charts. However, I would not go looking at the smaller time frame charts. You can infer what's going on simply by what you see on this chart. Different computers use different bars to count the legs. Doesn't matter. Is this the first push-up or is this the first push-up? Doesn't matter. Both computers, no matter how you do the count, see the same thing. They see a bull channel, maybe convergent lines. They expect a bear break below the bull channel. Again, very tight channel. Does not look like a wedge here. However, you can infer that it's a wedge on a smaller time frame chart. 3 pushes down here, and it's not really convergent. However, 3 pushes down, context is good for a wedge. We have a spike, pullback, and then possibly a channel. Strong enough breakout here for at least 1 more leg down. So 1, 2, 3. Traders will look for a reversal up. The closer something is to the ideal, the higher the probability that it will behave like the ideal. So the better looking a wedge, the more likely a lot of computers and traders will trade it like a wedge, and therefore more likely you'll get the reversal. The more likely a lot of computers and traders will trade it like a wedge, and therefore more likely you'll get the reversal. Wedge bull flags, we have a bull trend, and a wedge bull flag here, wedge bull flag here. And these bull flags, we have a couple bear bars here, 1 bear bar here, a couple bear bars here, 1 bear bar, another bear bar. And the bear bars are attempts to create a bear breakout. For the bulls, the bull bar that follows that bear bar is a pullback from that bear breakout. So we have a bear reversal or bear breakout, and then a pullback. Another bear breakout, another pullback. Another bear breakout, and another pullback. At some point, the bears decide that all of these strong bear breakouts are not working, and they stop selling, and the market then ends up going the other way. All of these reversal attempts are minor, and therefore part of a trading range or a bull flag. Wedge bear flag. The bull legs are sometimes small, 1, 2, 3 bull bars, and they're attempts to reverse the bear trend. Here, we try to reverse up, fail. Try to reverse up, fail. Try to reverse up, try to reverse up, and fail. Traders see this as a bull breakout, and then pullback from that bull breakout. Another bull breakout, pullback from that breakout. If the bull breakouts repeatedly fail, the bulls eventually give up, and the market goes the other way. Reversals in trading ranges are common, and a lot of the patterns are wedges. We have a bull breakout here, and then we have a small bear trend that's not falling very far, but this bear trend, this bear channel, I would call it a wedge bull flag, and we got a bull breakout. The pullback ended, or the pullback was a wedge bull flag. And that's true here as well. We're trying to trend down. We have a lower high, we have a lower low. It's a bear channel, but it has a wedge shape, and here it's only about a 50% pullback in a bull trend. The odds are this wedge bear channel is going to have a bull breakout, and therefore it's a pullback in a bull trend. Here we have a sell-off and a pullback, and this pullback has a wedge shape. It's a small bull trend. We have higher highs and higher lows, but the odds are you're going to get the bear breakout, so you can call it a wedge bear flag. Here as well, even though it doesn't really have a wedge shape, if you want, you can call it a wedge bear flag. A bull trend, but a minor reversal, and a bigger bear trend, maybe about a 50% pullback. This is really not a good example of it, but the idea is that you have a bear trend, about a 50% pullback, and you can infer that it's a wedge on a smaller time frame chart. So it's a wedge bear flag. The same is true here. This has a little bit better wedge shape, but it's a wedge top. Wedge bottom. I like to connect the first point with the third point. That means the second push is often below the line. Here's the start of the wedge, possibly the end of the wedge, and I ignore that second point going below the line. And that's true of a lot of wedges, that if you connect the first and third points, the second point is often beyond the line, and that's okay. Different ways to draw this, 1 or 1, and then 2, 3. I talked about this earlier, that we have a bull breakout here, and then bad follow through, a pullback, and that this resumption up, some computers see it as part of the pullback. Even though it's a new high in the bull trend, it could be part of the pullback that began with this bar. Some computers see this whole thing as a triangle, which means this big bull bar, in the minds of some computers, is part of the pullback from this initial breakout. Most wedges are not perfect. Any 3-push pattern qualifies, and therefore most channels are wedges. By the time you decide that you have a channel in front of you, you have 3 pushes, and therefore it's a type of wedge. And again, the closer it is to ideal, the higher the probability that you'll get a profitable reversal trade. 3 pushes up, again, I connect point 1 with point 3. If I use point 1 and point 2, point 3 will not reach the line. And I like the reversal to be taking place at a line. So if I see this bull bar and then a bear bar here, I think of it as a wedge. I draw a line 1, 2, 3, and I ignore bar 2 going above the top of the line, overshooting the line. Most spike and channel trends end with wedges. Strong bear breakout, so you think of it as a spike and a first push and a potential wedge. 1, 2, 3. Nested patterns are common. We have a big spike down here. We have a smaller spike down here. I mentioned that I think of wedges and channels as synonymous, and if they're convergent, I call them wedges if they're more powerful. Nested patterns are common. We have a big spike down here. We have a smaller spike down here. I mentioned that I think of wedges and channels as synonymous, and if they're convergent, I call them wedges. If they're more parallel, I simply call them channels. Reversal up with a decent buy signal bar. Whenever I see two reversals, I start drawing lines. I connect the lows and extend the line and see what happens. If we reverse up here and come back down here again, I would have a potential wedge bottom. I want to see what happens if we come back down toward that line. Do we reverse up? We went sideways and we had another bear breakout, but look what happened when we got right next to the line. We have a doji bar and then we have a micro double bottom. I think of this as a wedge, even though the shape of it is not all that good. The third push down did not quite reach the line, and therefore you have to be wondering, are we going to go a little bit lower? This is an undershoot. Undershoot means the push did not quite reach the line. Because traders are wondering if it's going to continue down a little bit further, buying above this bar, low probability. Higher probability to take a second entry buy. Here we have a micro double bottom and a second entry buy with a decent buy signal bar. And the result, we have a very strong bull breakout and at least a small second leg up. Again, as soon as I see two reversals, I draw lines. Reverse down, try to reverse down, I draw a line. And then I see what happens when the market gets back to that line, if it gets back to that line. And here we touch the line, went a little bit above it, and we have a bear bar. So this is a potential wedge top. Probably a minor reversal after such a strong breakout. Minor reversal means trading range more likely than bear trend. Small overshoot, that's a buy climax. We get the reversal. If you get the bull breakout and a reversal down, you have an increased chance of a swing down, especially with a pretty good sell signal bar here and a decent entry bar here. The bars are pretty small here, so this looks like it's not going to go all that far or all that fast. Usually, if I start to see this, if I short that and then the market does this, I just get out. Reasonable to short below the wedge, spike pullback channel, expecting a test with the bottom of the channel, but it took a lot of bars to get there. And as I said, I typically get out when the market starts to do that very tight range. Just because I see it as a wedge does not mean that all the computers see it as a wedge. Also, different computers will use different reversals to create the wedge. A bull breakout and 3 pushes up, so a small wedge top. Other computers will say, well, maybe the wedge top is 1, 2, 3, and we did not quite reach the third touch of the line. Maybe you want to call it an expanding triangle top. I don't know, but some computers will see the 3 pushes as 1, 2, 3. Other computers will say 1, 2, 3, and not call it a wedge, simply call it a bull channel. And then look for a reversal down, especially a second reversal down. First attempt, and then second attempt. The market tried 3 or 4 times to break to a new high, and it's failing. Instead of finding buyers eager to buy the bull breakout, it's finding sellers. Every time it goes above something, it's reversing. Above here, reversing. Above here, reversing. Above here, reversing. The bulls and bears are agreeing that the price is too high. It doesn't matter if you call it a wedge, an expanding triangle, or channel. The market continues to reverse after every attempt to break to the upside. Usually then the market tries to go the other way. It'll conclude it has gone too far up. Again, you can call it a wedge with a bad shape. You can call it an expanding triangle, a failed breakout above a wedge top, wedge 1, 2, 3. It doesn't matter. The market's repeatedly trying to go up and failing. You have to be thinking it may try to go the opposite direction, so traders will be looking to sell a reversal down. Either below that reversal bar, bull body, or higher probability below this bear bar closing near its low. As I said, there are many ways to draw the lines, and different computers use different algorithms, and they draw the lines differently. 3 pushes down, 1, 2, 3. Other computers will say the first push was here, 1, 2, 3. This push down from here was followed by a new high. You have a bear channel, but markets often transition, and there's often a time when it's both in a bull trend and in a bear trend. And that's why you can get a bear trend beginning before the bull trend ends, because you get the transition phase when the market is in both. You can draw the line 1, 2, 3, and call this an undershoot, did not quite reach the line. As I said, if I see a reversal up from a third push down, I usually connect the first point and the third point when I'm in my chat room to illustrate the wedge. Repeated reversals on sell-offs. Traders will look to buy a reversal from a third push down. If I see a reversal up from a third push down, I usually connect the first point and the third point when I'm in my chat room to illustrate the wedge. Repeated reversals on sell-offs. Traders will look to buy a reversal from a third push down. Here, different ways to draw the 3 legs down. 3 pushes down, 1, 2, 3. Not a very good looking buy signal bar, plus it's following 2 bear bars. Usually higher probability to wait for second entry, which we got above this bar. A bull breakout, bad follow through, first push down, second push down, third push down. An undershoot did not reach the line, and after this initial reversal attempt, we went to a new high. This bull bar, you can call it part of the bull trend, or you can call it part of the pullback from this initial breakout. Again, bull trends, when they transition into bear trends, usually have a period of time when it's both in a bull trend and a bear trend. Wedge bull flag, bull breakout, traders will buy ins, usually have a period of time bull trend, or you can call it part of the pullback from this initial breakout. Again, bull trends, when they transition into bear trends, usually have a period of time when it's both in a bull trend and a bear trend. wedge bull flag, bull breakout, traders will buy above a bull bar here, here, and here. This is not a bull bar, but it's a wedge bull flag. Other traders will buy above this bar, a bull bar closing on its high. This entire sell-off, approximately a 50% pullback from this breakout. You can call it a wedge bull flag, you can call it a higher low major trend reversal. Traders are going to look to buy reversals up. Wedge top, 1, 2, 3, with a bear II, an inside bar with a bear bar. Traders will take that short. Micro double top up here, and then down on that bar, and then up, and then down on that bull bar. I'm now going to talk about different types of wedges. Take a look at this. We have clearly a bear breakout and a second leg down, but here we have a bear breakout as well. But I'm now going to talk about different types of wedges. Take a look at this. We have clearly a bear breakout and a second leg down, but here we have a bear breakout as well, but it formed a higher low. This, in fact, is a type of a wedge pattern. There are 3 pushes down. Had this low gone below that low, you would call it a wedge. But what happened here is this is an undershoot. The third push down did not fall below the second push down. In fact, it did not get anywhere near the trend line at the bottom of the wedge. However, the forces that form this pattern are the same as those for a wedge. When the bulls saw this reversal up, they knew there might be one more new low. However, they were so confident that there would be buyers below this low that many bulls started placing limit orders above this low just in case the market did not fall there. And the result was we have a higher low and then a reversal up. However, it's a 3-push pattern, 1, 2, 3. If you want, you can call it a truncated wedge, but it is a wedge. And the bulls who bought here were buying because they assumed that if the market got below 2, there would be a lot of bulls buying there. And these bulls were just front-running the bulls who wanted to buy here. And the bulls who did want to buy the new low ended up having to chase the market higher. The bad shape, the lack of a wedge shape, the lack of a third push below the second does not matter. It's the same forces that create this as create a wedge. You can call it a higher low. It is a higher low, but it's really a variation of a wedge. The market tried to get a bear breakout 3 different times, here, again here, and failed all 3 times, and then it decided to try it in the opposite direction. That's exactly what happens in a wedge. The market makes 3 attempts down. However, typically the third push is below the second. All 3 fail. The market then decides it cannot go lower, so maybe it's gone too low already, and then it tries to probe in the opposite direction. When the bulls and bears are both confident that a third push down to a new low will create a wedge reversal, many bulls buy early, and a lot of the bears take profits early. The bears are selling reversals up, betting that they'll fail. They'll sell here. However, if they're deciding that this is too strong a buy setup, a very good bull bar here, chances are there'll be buyers below. A lot of the bears will take profits early because they do not want to take a chance that the market might form a higher low. So the bears are starting to scalp out early, and the bulls are becoming very confident. A pretty good reversal here, very good bull bar here. Really not a lot of strong selling. There's some, but look at all the bars to the left. This is a sell-off, but very weak. Traders, both bulls and bears, are now confident that there's not much left to this bear trend. And the result was a higher low instead of a lower low, but it's still a variation of a wedge. Too many traders trying to buy around that second low. Bulls trying to buy for a swing up, and bears trying to buy back their shorts. Take a look at this. We have a double top. We have a head and shoulders bottom, left shoulder, head, right shoulder, or a double bottom, right shoulder. And we're getting a bull breakout above the neckline of the head and shoulders bottom, and a breakout above the double top. But think about what's going on. The bulls are trying to rally. They fail. For a swing up, and bears trying to buy back their short right shoulder. But think about what's going on. The bulls are trying to rally. They fail. They're trying to rally again, and they fail. And they're trying to rally a third time, and look what's happening. They're failing. This is a 3-push pattern. Anytime you have a double top and then a bull breakout, you have 3 pushes up. If that third push fails and the market reverses down, this is a variation of a wedge. And the computers will treat it like a wedge. 3 strong pushes up, each one reversing. They'll bet that the market has decided it cannot go up. Maybe it has gone up too far. Maybe it now needs to go down and find what price is too low. Bears, they see a double top bear flag. They'll sell the reversal down. And a lot of them will put their stop just above the double top, and they'll get out here as the market is going above the double top. The bears will buy back their shorts, and the bulls will buy as well. The bulls see it as a bull breakout above a double top, and they expect a measured move up. However, the market then reversed down, a big tail, and now a bear bar. Traders will start to sell. Bulls will sell out of their longs if they have not already taken profits, and bears will start to sell either here, or they'll wait until after they see many consecutive bear bars, and now we have a low 2 bear flag, low 1 below this bar, low 2 below that bar, and they'll sell here. Higher probability selling after you see 3, 4, or 5 bear bars after the reversal down, but both shorts are reasonable here, or selling closes on the way down here. are reasonable here, or selling closes on the way down here. 3 pushes up or down, that's not enough. They have to be strong compared to the other bars and the other legs. Context, the bars to the left have to make sense for a reversal. Otherwise, the market is only going to go sideways. Here we have a wedge, 3 pushes up, 1, 2, 3, but there's nothing to reverse. The market is really not going up all that much. It's simply part of a trading range, and therefore the reversal down is probably going to lead to more trading range. Leg 1 up, reversal down, not all that strong up. Leg 3 up, not all that strong up. Most computers will not consider this a wedge. There were not 3 strong pushes up. There's 1 strong push up here, but not 3 strong pushes up. Traders will see this more as legs within a trading range, and they'll expect more trading range, not 3 strong attempts to rally that are failing. Here we have 3 pushes down, 1, 2, and 3, or 3, or 3. However, it's in a tight trading range. There's really nothing to reverse. The market might go up, but more likely the tight trading range will continue. Markets have inertia, and they tend to continue what they've been doing. And if it's been in a tight range for 15 or 20 bars, it's more likely to continue in a tight range than it is to get a bull breakout and resumption of this small bull trend. If a pattern does not look right, computers will ignore it, and you should ignore it as well. In general, traders will call it something else. For example, if the reversals are all around the same price, traders will call it a triple top or triple bottom instead of a wedge. If the context is good and if the legs are strong, it's still tradable. 3 pushes up, maybe it's a wedge top. This is actually what I would call a small breakout of a small breakout. Here's a small breakout of this. This is a small breakout of that. It's mostly horizontal, and we have an attempted reversal down. There's a higher probability of a measured move up when you break above that. In general, if you break above any kind of a wedge, 50-50 chance you get a swing up, 50-50 chance you get a reversal down. But when the pattern is more horizontal like a trading range, in general, if you break above any kind of a wedge, 50-50 chance you get a swing up, 50-50 chance, there's a higher probability of a measured move up when you break above that. In general, if you break above any kind of a wedge, 50-50 chance you get a swing up, 50-50 chance you get a reversal down. But when the pattern is more horizontal like a trading range, and you get a small breakout of a small breakout, it's closer to 60% chance of a measured move up, a swing up. Pretty good bull bars here and again here. Increasing buying pressure in a trading range. The odds are we're going to get a bull breakout and a swing up. You can also call this a head and shoulders bottom if you want. Left shoulder, a lower low, head, and then the right shoulder. You can call it a double bottom pullback, a double bottom, and then a pullback, which is a type of triangle, even though this low is below that low. Many different terms for the same pattern. For me, it's mostly a small breakout of a small breakout, where all 3 legs have good buying pressure, and there's an attempt at a reversal down after the 3rd breakout attempt. The market's also in a broad channel. We're getting higher lows and higher highs, and there was room to the top of that channel. If you have legs within a tight trading range that are strong enough, you can get a minor reversal, for a scalp in other words, but rarely will you get a swing trade. 3 pushes up, 1, 2, 3. Selling below this, we have a bear II, a bear inside bar, inside of another inside bar. The sell here is probably going to result in simply another leg in the trading range, and therefore a scalp and not a swing trade. 3 pushes down, 1, 2, 3, not all that strong. A second entry buy probably would be a scalp. Here, the bull's got a break to the top of the range, and then terrible follow through. Same thing here, 3 pushes down, not very strong, basically in a tight trading range. If you're taking this buy, you're probably looking for a scalp up to the top of the range. None of these has a wedge shape, but they all function as a wedge. The market made 3 strong attempts to go one way, and the breakout failed. The market gave up and tried the other direction. The same forces as in a wedge, but here the patterns are small and sideways. They're minor reversals leading to scalps. Usually when I see patterns like that leading to scalps, that really don't look like wedges and the context is really not good for much of a breakout, I do not use the term wedge. I use other terms like a triangle or a triple top or a triple bottom, or simply call it a tight trading range. Instead of worrying about a wedge here, I would simply call it a tight trading range. I mentioned earlier, a breakout above a double top that fails is a wedge top. If you have a double bottom and a bear breakout and it reverses up, you have 3 pushes down. Computers will treat it like a wedge. Here we have an attempt at a double bottom, and we have a bear breakout. 3 pushes down, 1, 2, 3. To me, it's functionally the same as a wedge. I could have drawn a line across here. You can call it a triangle, you can call it a wedge, but it's the same forces that a wedge has, 3 pushes down. So if you get a breakout below a double bottom and it reverses up, it functions the same as a wedge, and you look for a reversal up. Here, in a tight trading range, you're not looking for much of a reversal. It turns out we got a pullback and then a second leg up. But in general, a breakout below a double bottom that reverses up is a type of a wedge because it's 3 pushes down and all 3 reversed up. The same here. We have a double bottom, and then we have a bear breakout, and it reversed up, and it reversed up a second time. I would not call it a wedge. I would call it a double bottom with a failed breakout. However, it is a type of wedge. 3 pushes down, all 3 reversing. Double bottoms, bear breakout, reversed up. They function as wedges. Here, double top, and a bull breakout that reversed down is 3 pushes up, 1, 2, 3, and all 3 are reversing. The market's deciding that up is not the right direction. It has to probe lower. It's a type of wedge. However, I usually refer to this as a failed breakout above double top. Same thing here. We have a double top and a breakout. 3 pushes up, 1, 2, 3, and then it reversed down. You can call it a wedge. It's a type of wedge. It's the same forces as a wedge. A lot of traders would simply call it a triple top or a failed breakout above a double top, or they would look at this and call it a tight trading range and a failed breakout above the top of a tight trading range. Big bear breakout, closing below the low of the wedge, closing below the low of the past 30 or 40 bars, probably going lower. Traders will sell the reversal down, or after this breakout, this is a bear flag, they'll sell below the low of this bar, betting that the bear trend will resume down. It's higher probability to sell after you see a strong bear breakout. I made the point in this video that wedges are rarely perfect. Also, most channels, whether or not they're convergent, are variations of wedges. And then I talked about some variations of wedges, like failed breakouts above double tops and failed breakouts below double bottoms. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on wedges.
This one. OK，那今天呢，我们来讲一下我今天今天我来稍微提一下我今天学到的这个痛苦交易啊。那什么叫痛苦交易呢？就是当今天多空呢都是往，那今天呢市场的行情走的跟多方和空方 大部分的人都不相同的时候呢，很多人就因为现在的趋势这个动能去做交易，而不是因为价格太高、价格太低，也不是因为基本面哦。像在这个地方是有一个下跌的一个趋势的，像在这个地方其实是有一个下跌的一个波段，那这个波段呢中间其实是蛮多十字星，所以很多交易者会认为说这个波段它其实是一个盘整行情的一个第一段下跌，因为这段行情它并不是一个很强烈的 breakout， 那接着呢所以那些 trader 呢就会希望，所以那些交易员呢，他们就期望说，接下来回调的这个幅度，接下来如果市场要走一个回调阶段的话，那这个回调阶段它是会比较深的，就是他们会期待说，接下来可能会走一个比较大幅度的，像这样子的一个盘整行情，它可能会比较像这样子的一个盘整行情，可能会比较符合所有人的期望啊。那结果呢，接下来的行情呢，却是走一个浅的回调，接着继续往下掉。那这继续往下掉的这个波段是相当的重要，就是这个波段有很多这种跳空的。那在这种波段呢，有很多像这种跳空的一个缺口，跳空的一个缺口，跳空的一个缺口。那这代表着什么？这代表说很多人呢在这一个低点，他就直接收盘，就直接卖空了。那这个地方卖空，它其实不是因为他觉得现在价格太高啊，或什么之类的，它并不是因为觉得接下来价格太高，所以继续想要赌它会下跌哦。它只是因为这边的这个动能很强哦，他觉得接下来再继续往下跌的几率是，他觉得接下来在这边交易的交易员呢，会觉得这边的一个动能是很强的哦，他们期待接下来在这一波下跌还会有第二段行情的出现，所以他们会在这个地方的卖盘去。这个地方的收盘去做空，那这个地方收盘，他们做的就跟我们前面提到的一样，他们做的并不是因为价格。那在这个地方做空市价，那在这个地方在收盘做空的人，并不是因为价格低而去做多，而是因为 FOMO fear of missing out， 他们害怕错过这一段行情。所以一旦今天他们做这一单的理由，也就是我们的动能向下的动能消失之后呢，市场就会比较来了，市场可能就会市场就会面市场呢可能就会有一波比较强烈的一个反转。所以当这个下跌的动能消失的时候呢，市场就会迎来。所以那因为在这边做空的人，他们做空的。因为在这边做空的人，他们做空的理由不是基于市场的价格，也不是基于基本面，而是基于他们害怕错过这一波很强势的动能。所以一旦这个动能消失之后呢，市场就会往上有一个还不错的一个。所以一旦这个动能消失之后呢，市场就会有一个还。所以一旦这个动能消失之后呢，市场就会有一个还不错的一个反转哦。那这一波下跌呢，很多人都会认为说，那今天我们来讲一下这个叫做 叫什么？痛苦交易叫 pen trading。那今天呢，我们来讲解一下有关于 pen trading， 也就是我们痛苦交易是怎么样子发生，那为什么会像这样子一个 pen trading 呢？就好，那我们可以看到这一波的下跌，它其实它不是一个很强烈的 breakout， 它中间有一个十字星啊，或者是这种下跌的。 这种一下涨啊，一下回调，一下涨一下回调这种不确定性，对我们交易者而言呢，对我们学习 price action 的人而言呢，你可能会把它认为说，接下来这个地方可能是对我们学习 price action 的人呢，对我们学习price action 的人呢，我们可能会认为说这一段下跌是一个趋势。那对于我们学习 price action 的人呢，我们可能会认为说这一段下跌是一个 trading range， 也就是我们盘整行情的一段下跌，所以我们会期待呢这一波上涨会有比较深的回调。当我们带入这个偏见之后呢，我们觉得接下来可能会有一个比较深的回调，或者是在这个地方创立出一个顶部形态的话呢，当我们带入这个偏见的时候，价格却在这个地方就直接往下掉了。当我们带入这个偏见之后呢，价格却没有照着我们这样子走，打破了大多数人对于这一笔交易的一个期待的时候呢，价格这样子往下继续的创立的更低的一个低点。那这时候呢，我们后面又发现，那这时候呢，很多在这边做多。那这时候呢，很多在这边做多，在这边做多，在这个回调这个地方做多的人呢，他们都会被套。那这时候呢，很多人像在这个地方做多的人，或在这个地方做多的人，或在这个地方等到high three 进场点的人做多的人呢，他们都会被套牢。他们被套牢之后呢，价格出现了一波延续一段时间的下跌。那这个下跌，那他们被套牢之后呢，就会出现一个延续。那这时候呢，有些人被那这时候呢，出现了一个延续下跌。那这时候呢，出现一个延续很多根 K 线的这个下跌，就把前面的这些在这个地方做多的人全部都给套住了。而且我们可以发现哦，这一波下跌，很多人都是在这个收盘的时候去做空的，在收盘的时候去做空的，所以很多跳空缺口。那这一波下跌的这个跳空缺口是什么造成的呢？并不是价格造成的，并不是因为价格太高，或者是因为基本面而造成的，只是因为很多人 FOMO， 他们害怕他们拿不到这个因为动能所带来的一个趋势，所以他们选择在这个地方做空。所以一旦这些因为动能而去做空的人，那这些因为动能而去做空的人，一旦动能消失的时候，他们就会恐慌抛售。那原本被所以他们呢就会恐慌。所以我们可以看到，在这个地方价格回来的这个趋势的时候呢，我们可以看到这一波上涨就是由这些原本在下面做单的人恐慌抛售所造成的。那我们也可以发现一件事情，就是刚刚在这上面被套牢的人呢，价格到达原本的位置之后，有一个阶段性的止盈，因为他们已经浮亏了这么一长段时间，所以价格任何时候回到他们的开仓点位的时候，他们就会做一个阶段性止盈。所以在这个地方就有一个阶段性的下跌，并不是价格要继续往下，而是多头在这上面原本开仓价阶段性的止盈。那这就是我今天学习到的 pen trading 哦，分享给大家。
This is Al Brooks. Thank you for watching the Brooks Training Course. This is the third of 5 videos on wedges.
太尴尬了，我脸上皮肤好不好，只有我自己才能知道。但我直播间不开滤镜和磨皮的，我现在卸给你们看。凑近给你看。我把我底妆给你，告诉你们，别告诉其他人，好不好？别告诉你们敌蜜们，我们偷偷变美。我在包里拿出来，但是我已经用空瓶了，我给你们看一下我的用量，看到没？我已经全部用光了，巨好用，很润很润。我这用手，我先用手，本来它是带粉扑的啊，可以看一下它有多绝。
那时候原本户头快要归零，想着就准备回国券。在接触营收以前做的就是操作管理嘛，也是请团队，但是当时候来的，要么加钱要处理很久啊，简单讲就不是我们目标的客户。
今天我来做一个见证，我现在人在上海，然后我今天就自己来到这个酒吧，然后呢我就在旁边的时候，我就在那边喝我的酒，结果呢我就碰到这些弟兄，他呢也是自己来，然后我们就开始聊天，因为旁边人我们也不知道他干嘛，结果他跟我讲，他是跟我同教会同一个小组，然后我们住同一个地方，你就想这个到底有多扯？你要分享一下？
超级扯！当他问我说跟我怎样聊天，他就问我说你哪里人？我说我来自台湾。然后后来我们就交换了 Instagram。他看他说你也在教会吗？我说对。然后后来他又说你也在夏凯纳，就是一个教会。我说对。结果才发现我们在同一个 group 里面，超级夸张，
太扯了，大家赶快去教会，你知道？有今天我。
Took away the profit stream, for profit on the street. But she's stronger than gold. All this news starts to grow. Everybody
只跟你在交往，交往，干嘛？有没有？我寄眼神给你出去，你在交往，干嘛？就敢。
제가 진짜 웃긴 거 발견했어.
这世界真是。交易模型可以说是。
趁你老板不注意。
Back at you. Bad girl. Is it bad? Bad girl. Is it bad that I never
How old are you?
29.
Oh, okay.
Why is it that women are allowed to ask how old a man is, but it's taboo for a man to ask how old a woman is?
I think it depends on the context. Like, you can ask a woman how old she is. Like, I wouldn't be offended if you asked me how old I am.
Did you pause waiting for me to ask? I won't ask. How much do you weigh?
Oh.
Why is it that women are allowed to ask how old a man is?
I used to think that I was a fine enough. And I used to think that I was
Ah!
She said, do you love me? I wanna tell her.
每天都想可以快点见到他的手，到他也是再次他的味道来了，好刺痛。正当我想着 baby， 希望他马上就来，意外发现他的手机没带，我才意外。总以为他会永远陪我，一步一步慢慢走。总以为无聊到有趣的幽默，只有他能懂。我不是他的菜，早该把手松开。Oh, girl, yeah. So, 这么想找借口忘记，是什么？你想你我是全都当比，翻到脑袋都快要宕机。我爱哟，只是爱哟呀，爱哟呀爱，为何你的秘密不散？哦爱，现在已经麻痹无感。哦，到底是怎样？也别问，很可怕，无垢。他意外。谢谢看那个啥的差点，看到没啥的 said I want you tonight and I want you tonight。去看那啥的差点，and I want you tonight and I want you tonight。
I want to begin by making the point that a bad wedge is not a reversal setup.
You too much, and I want you too much. you too much. Love you too much. You too much.
I feel like I'm walking on the moon. Inhaling life is a balloon. 난 너무 사사로운 눈. 살 건 이젠 없어. I got what I hit, little babe. No, I never real thing. That's not a big deal, babe. 오타고 가자, real time is ticking, babe. 가본 적 없는 대로 그냥 직진, babe. 난 마이클 잭슨처럼 moonwalking. Hallelujah. Someone said I'm gonna make it. 내 앞자리를 지켜줘, baby. 지금 보는 것처럼 I'm ready.
시간은 잠을 자면 따라다다다다 You too much. You too much.
It's not going to lead to a reversal. Next, very often when you have a wedge, the reversal trend, the opposite trend, begins before the old trend ends. If you go from a bull trend to a bear trend, watching the trading course. This is the third of 5 videos on wedges. I want to begin by making the point that a bad wedge is not a reversal setup. It's not going to lead to a reversal. Next, very often when you have a wedge, the reversal trend, the opposite trend, begins before the old trend ends. If you go from a bull trend to a bear trend, or a bear trend to a bull trend, there's usually a transition, during which time both trends are in existence. Finally, you can often enter earlier on a smaller time frame chart, although most traders should stay with just one chart and not look at other charts. The market's breaking to the downside, and again here, and you can count 3 pushes down, 1, 2, 3, and therefore a wedge. But a wedge alone is not a reason to buy in a strong bear trend. This bear channel is very tight. If you get a reversal, it's probably going to be minor. Bear trends are always forming wedge bottoms. 1, 2, 3, 1, 2, 3, 1, 2, 3. And just because you can count 3 legs does not mean it's reasonable to expect a reversal. A tight bear channel like this is a breakout on a higher time frame chart. When the market's in a breakout, a bear breakout, you should only look to sell and do not look to buy. Any reversal like this or like that is profit taking by the bears who will be looking to sell again soon. It's not a realistic attempt at a bull trend. The reversals become bear flags, not bull trends. look at this. We have a leg down and we have a reversal attempt, but the high did not go above the low of the breakout point. There's a gap. We have another bear breakout, another reversal attempt. Good looking bull bar, but it did not close the gap. This bear trend is forming gaps. When the legs do not overlap, when you're forming gaps like that, the bear trend is too strong to buy. Also, where are all the bull trend bars? Where is evidence that the bulls are strong? You have one bull. The bear trend is too strong to buy. Also, where are all the bull trend bars? Where is evidence that the bulls are strong? You have one bull trend bar here, but look at the follow through. And finally, the lines are not convergent. There's not a wedge shape. The stronger a bear trend is, the stronger the buy signal bar has to be to overcome the strength of the bear trend. And here, there are no really strong bull trend bars. There's a bull reversal bar here, a small one here. Does this small doji look big enough to reverse that bear trend? No. And the same with this. We have a good entry bar, but where is the follow through? We have a bull breakout and a very tight channel. And on a higher time frame chart, this is also part of the breakout. This breakout would be continuing up on a higher time frame chart. And when the market's in a tight channel like this, or in any kind of a breakout, only look to buy, do not look to sell. Bull trends are always forming wedges. 1, 2, 2, 3, or 1, 2, 3, 1, 2, 3. You can count them any way you want. But all of those wedges are within tight bull channels, and therefore the reversals are minor, probably leading to a bull flag and a resumption of the bull trend. Not a reversal. Remember my 80% rule. If you're in a strong bull trend, 80% of reversal attempts fail and become bull flags, and the bear scalpers keep losing money. They keep selling. They sell a failed breakout. They sell a final flag reversal. They sell a wedge top, another wedge top, another wedge top, another wedge top, and they keep losing money. In any trend, traders are always counting reversals. Reversal down to the end of leg 1, another reversal down, end of leg 2, and now we have a third leg and pullback, end of leg 3. Whenever traders are counting bars or counting legs and they see a strong breakout like this, it's usually better to start the count over again. Instead of calling this bar 3, traders should call this bar 1. Call this bar 1. Whenever traders are counting legs and they see 3 pushes up, it's important to pay attention to symmetry. In general, you want the spacing to be about the same between point 1 and point 2 as it is between point 2 and point 3. If there's too big a difference between the spacing between point 1 and 2 and then point 2 and 3, computers tend to ignore this as a channel. Here there are 21 bars between 1 and 2, only 7 bars between 2 and 3. That is getting to be a little too asymmetrical, and traders tend to view this less as a wedge and more as a bull channel with more to go. This strong leg up, a lot of traders would restart the count and say this is point 1, this is point 2. Strong bull breakout, start the count over. This then is point 1, point 2, point 3.
Heads! Heads!
We have 3 pushes down, 1, 2, 3, convergent lines, and a gap, this high and the breakout point. That is a problem. Whenever there's a gap, even though this bar pulled back above the low of this bar, this is the bottom of the first push down, and we did not go above that low. Whenever there's a gap in your wedge, the channel down is usually too tight to begin looking for a reversal. Wedges usually need stairs. They need overlapping with the pullback from the breakout going above the breakout point of the prior leg down. As a sign of buying pressure, you can also call it a wedge 1, 2, 3, but same problem, no overlap, and therefore it's probably not a reliable wedge bottom. 1, 2, 3, and then start the count over, strong breakout, 1, 2, 3, still forming gaps. That means the channel down is too tight, and the reversal probably will be minor. The limit order bulls buying below bars are losing money. If the limit order bulls are losing money, the stop order bulls buying above bars probably will lose money as well. Therefore, the bulls are too weak to be looking for them to create a reversal up other than a minor reversal. The channel is very tight, it's not broad, no consecutive big bull trend bars, not enough buying pressure for a reversal, and therefore a reversal up is probably going to lead to either a bear flag and another leg down or a trading range. And here it did both, tight trading range and a new low. Sometimes the legs in a wedge are subtle, and sometimes it's only a bull bar followed by a bear bar. This is a nested wedge. We have 1, and then a reversal down 2, and a reversal down 3, but the third leg subdivided into a smaller wedge, a bull bar and then a doji, a bull bar and then a bear bar, a pair of bull bars and then a bear bar. On a smaller time frame chart, it would be a wedge. On this chart, it's inferred. Whenever you see a bull bar and then a bear bar or a doji bar, that is a first leg. Another bull bar and then a bear bar, that is a second leg. Very tight bull channel here, and the entire channel is tight, and therefore the first reversal down probably is going to be minor, leading either to a bull flag or a trading range. Here we got a 15 bar tight trading range, TTR tight trading range. Within it, there's a small wedge, 3 pushes up, bull, bear, bull, doji, and then a third push. You often get a lower high major trend reversal when there's a tight trading range after a bull trend. Doji, and then a third push. You often get a lower high major trend reversal when there's a tight trading range after a bull trend. Doji, and then a third push. You often get a lower high major trend reversal. when there's a tight trading range after a bull trend. It usually comes as some kind of a double top. You can say this bar is a double top with that bar. The probability, like most major trend reversals, is low, maybe 40% chance you get a swing down. But if you wait for the breakout and then sell, the probability of lower prices and making money is higher. Selling late, the stop is further away, so the risk is greater. Selling early, the stop is close, the risk is less, but the probability is less as well. Both are acceptable. Here we have a wedge bottom, 1, 2, 3, and the minimum that traders need to see to conclude it's a wedge is a bear bar followed by a bull bar. So 1, pullback, and then 2, pullback, and then 3. However, there's a smaller wedge as well. A bear bar, doji, and bull bar, and then bear bar, bull bar. This is also a smaller wedge. 1, 2, 3. So different ways to draw it. 1, 2, 3. And the bull's got a higher low major trend reversal. They have a bear trend, possible final flag, lower low major trend reversal. Not much of a strong breakout, but we had several strong legs up. Traders will look for the bear breakout below this trading range to fail. This trading range then will probably be the final bear flag. You can call this a final flag reversal or a lower low major trend reversal. You can say bear trend, bull breakout by going sideways, and then resumption of the bear trend that failed. Good reversal up, and then a spike and channel down, spike, first push, second push, third push, with a good buy signal bar. I think it's important to realize that most reversals begin before the prior trend ends. There's a transition. Here we've got a bull trend and a wedge bull flag. 3 pushes down, 1, 2, 3. But look at this push down. This bear channel, a small bear trend, began before the bull trend ended. And the same here. We have a push down, a new high, and then second and third push down. You can call this a triangle or a wedge. This is the first leg down of this wedge channel, this triangle. Yet it occurred before the bull trend ended. The same here. This wedge bear flag, bear channel, began before the bull trend ended. And that makes sense. Usually a bull trend does not go into a bear trend. There's usually some kind of a transition. And the transition often is the first leg of the bear trend begins before the bull trend ends. The same here. First leg down in what became a wedge bull flag came before the bull trend ended, and the same here. You could say that the bull flag began here, 1, pullback 2. I think it's more realistic to say this was the start of the bear trend, and there was a transition in here where the bear trend was beginning and the bull trend had not yet ended. The same with here. You could say it's a high 2 buy, leg 1, pullback, leg 2. I think it's probably more of a wedge bull flag, and the bear trend and bull trend coexisted. There was a transition. The bear trend began before the bull trend ended, and the bull trend was still in effect, even though the wedge bear channel had already started. This is how I would label it, 1, 2, 3. And the same here. I think this is part of the correction, even though the bull trend has not yet ended. In any case, whether you call it a high 2, 1, 2, or a wedge 1, 2, 3, you're going to buy the reversal up, and the same with this as well. Legs can be small, sometimes as small as a single bar. You can look at a smaller time frame chart, but it's usually not worth doing. You can just infer what's going on by the appearance of what's going on the 5-minute chart. Here, we have a leg that is only a single bear bar, and it's followed by a bull bar. So to me, that's a leg down, and it ended with this bull bar. Here we have a few bars down, and ended with a bull bar. Here, a few bars down, ended with a bull bar. Here we have a tail. The market traded down and traded up. On a smaller time frame chart, that is a small leg 1. We have a bear bar followed by a bull bar. This is a leg 2. We have a bear bar followed by a bull bar. That means it's the third reversal up. This is a small wedge bull flag. On a smaller time frame chart, you'd see it, but you can infer it simply by looking at this, and this is all that you need to see. The same here. A doji bar went down and up. We went down and up, and then we clearly went down and up. This is a type of a wedge pullback, even though it does not have a wedge shape. And the same here. We have a bull breakout and then a bear inside bar. That could be the first push of a wedge bull flag. In fact, that's how I would label this. You could call it simply a high 2, leg 1, pullback, leg 2. I would call it a wedge bull flag. 1, 2, 3. Where the market transitioned. Here, it was still in a bull trend, and it was in the start of a bear trend. The important thing is to realize it's a bull flag, so you want to buy the reversal up. Whether you call it a high 2 or a wedge, you want to buy the reversal up in every instance. 2 or trend. Bull flag. 1, 2, 3. Where the market transitioned. Here, it was still in a bull trend, and it was in the start of a bear trend. The important thing is to realize it's a bull flag, so you want to buy the reversal up. Whether you call it a high 2 or a wedge, you want to buy the reversal up in every instance. A wedge bear flag is a small bull trend, and it can begin while the bear is still underway. This is usually a transition. The first push up can be a lower high in the bear trend, followed by a new low, but still part of the bull channel, the bear flag. For example here, strong reversal up, yet the bear trend continued. A second push up here, third push up here. You can call this a wedge bear flag, even though the bear flag began before the bear trend ended. The same with here. A transition, we're in a bear trend, yet we're starting to have a bull trend before the bear trend ended. There's usually overlap between the bear trend and the bull trend. There's a time when both are in effect. Here, I think this is the start of the bull trend, a bull trend bear flag. Every bear flag is a small bull trend, yet the bear trend still is working lower. You can call this 2 legs up, 1, 2, or you can say maybe it's a wedge bear flag where the bull trend began here, and then 2, and then 3. That's how I would label this. I would label this a wedge. I don't have a line drawn in here, but if you did draw it in, this would become a wedge-shaped pattern. Again, the rally, or wedge rally, it's a small bull trend, I think began here, while the bear trend was still in effect. This is a transition from bear to bull, and there's a period when both are still operating. The bull trend is beginning, the bear trend is still continuing, and this bear leg is part of the bull channel. The same here. As you can see, it's pretty common. Reversal up, the bear trend is continuing, but this reversal up is the first push up in a wedge rally. The key point, you're in a bear trend, you're looking to sell a reversal down from every rally, betting that the rallies are minor and therefore bear flags and that the bear trend will resume. So you sell below the low of that third push up. You can enter earlier on the smaller time frame chart. I think traders will make more money if they just trade the chart that's in front of them and not look at other charts. This is the euro versus the yen, a monthly chart, clearly a wedge bottom, 1, 2, 3, or 3, and then a good IOI buy setup here. Some traders will anticipate this, the reversal, they'll see the wedge, and they'll start looking at a weekly chart or a daily chart, or even a 60-minute chart or a 5-minute chart for a reversal that could lead to a swing trade up. A lot of times the first attempt will fail. Here we have a lower low, we have a wedge, 1, 2, 3, nested maybe, 1 or 1, and then 2 and 3, a reasonable buy, fairly tight channel, weak buy signal bar. This reversal probably is not going to be successful. But this one, we have a bear breakout, a good reversal bar, another bear breakout, another good reversal bar, has a higher probability of success. If you're trading the monthly chart, you buy above the high of this bull bar, and here's your fill price, 99.18. Again, you can draw the wedge 1, 2, 3, or 1, 2, and then 3. Some computers do it one way, others will do it the other way. This is a daily chart of that same reversal. If you were buying on the monthly chart, this is where you would be buying, 99.18. On the other hand, if you look at that monthly chart and you saw the wedge starting to form, you could look at a daily chart and try to enter earlier, like for example here, 95.21, or here, 96.91. This is the euro versus the dollar on a 60-minute chart. And you can see maybe we're forming a wedge, 3 pushes 1, 2, and starting to push up here, 3. You got a wedge bull flag, 3 pushes down, 1, 2, 3. If you're anticipating a continuation of the bull trend, then you might start looking for bull flags. And if you see a first push and a second push down, this is strong enough so that we probably are going to get one more push down here. You can take the trade on the 60-minute chart, buying above the high of this bar, or you can look at a smaller time frame chart for an earlier reversal. If you buy the wedge bull flag here, your entry is here, 1.0795. And this is the 5-minute chart. This would be the 60-minute entry right there, 1.0795. However, on the 60-minute chart, you saw the possibility of a wedge bull flag. You could look at a 5-minute chart for an earlier entry, for example here or here, a micro double bottom or a triangle, 1, 2, 3. The entry price is 1.0780, about 15 pips lower than the entry on the 60-minute chart. I began by talking about how bad wedges are not reversal setups. Bear trends are always forming wedge bottoms that are bad and the market keeps going lower. Bull trends are always forming wedges right there, 1.07, and starting to, and then 2, IO. Look at that monthly chart and you saw the wedge starting to form. You could look at a daily chart and try to enter earlier, like for example here, 95.21, or here, 96.91. This is the euro versus the dollar on a 60-minute chart. And you can see maybe we're forming a wedge, 3 pushes setups. Bear trends are always forming wedge bottoms that are bad and the market keeps going lower. Bull trends are always forming wedges that are bad and the market keeps going higher. A bad wedge is one where the legs do not overlap. It's not a stairs pattern. There are open gaps, or the channel is too tight to expect a major reversal. I then moved on to talk about how new trends begin often before the old trend ends. There's usually a transition from one trend to the other. And finally, I talked about how traders sometimes like to enter early. If traders are trading a very high time frame chart, a monthly chart, weekly chart, 60-minute chart, they will often look at a smaller time frame chart for an earlier entry. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on wedges. I want to start by talking about
Hello, Michael.
Probably more buyers than sellers below this low, and that's true. Some of these bulls will not exit here. They'll use a wide stop, maybe based upon a measured move down, so stop somewhere down here, and they'll buy more, either at this low or on the reversal up. Bulls will not all that strong. Bad follow through, a lack of consecutive bear bars. Probably more buyers than sellers below this low, and that's true. Some of these bulls will not exit here. They'll use a wide stop, maybe based upon a measured move down, so stops. Somewhere down here, and they'll buy more, either at this low or on the reversal up. Stop just below a measured move down, either from a high low. I talked about failed wedges and how if you have an obvious stop and the wedge stop gets hit, 50% chance the breakout will lead to a measured move, 50% chance the breakout will fail, and you'll get an obvious stop and the wedge stop gets hit. %50 chance the breakout will lead to a measured move, 50% chance the breakout will fail. And you'll get a second attempt to reverse. I'm Al Brooks. Thank you for watching.
嗯。